Let's talk more about this. Joining me now to tell us what to make of all this volatility is Patrick Young. He's the chairman of Exchange Invest. So glad to have you on the show.
Thank you. Joy to be here, Alison.
So this isn't the first time investors have received surprising economic news. What's the driver, or what are the drivers that we're seeing for yesterday's significant sell-off?
Look, it's a cornucopia of factors, actually, Alison. You mentioned very, very well what's going on in relation to the Federal Reserve, etc. In the big wider world, take that great New Yorker's cartoon of Manhattan. Those things that are happening way beyond the purview of the New York Stock Exchange have had cause to cause us some concern. And therefore, we've got an upheaval in Bangladesh, Sheikh Hasina. There are all sorts of other issues in the Middle East. And most importantly, I suppose, the thing that we haven't touched upon so far is the end of the Japanese yen carry trade. Because while the Fed weren't cutting interest rates last week, Japan finally moved into positive interest rate territory for the first time essentially in a generation. We actually have the possibility to earn some money, an infinitesimal few basis points on our Japanese yen. What did that do? Well, a lot of people, they've been borrowing very cheap money in Japan and lending it to the rest of the world, or using it to buy assets. And a huge amount of the shock that we saw that came into the market, especially in Japan yesterday, but also to that same degree in New York over the course of the last couple of days, was driven by a lot of sudden fear that an incredible epoch is over. The era of free money in Japan is coming to an end. And at the same point in time, the Fed seems to be strangling the market with what the current generation of traders think are unseemly high interest rates. But unfortunately for grizzled old traders like me, they seem like a drop of the ocean and rather normal.
All right, so let's talk about the Fed then. It signaled that it could start cutting rates in September. The economic data that we've seen definitely favors the move. Do you think, first of all, that the Fed has held rates where they are for too long?
I think the Fed has found itself in an invidious position, so therefore it has probably held rates for rather too long at this sort of level. But of course the difficulty is that the Fed is under fire because it held rates far too low for far too long, and that's why the ghost of inflation is back upon us. How ironic, 45 years ago today, Paul Volcker entered the Federal Reserve Bank and he started killing inflation. It was a dragon that took 20 years to slay, and yet under the current Fed management they let it all out of the bag again within the course of a year or so over COVID. So therefore, the Fed's traumatized. That's why they're slow to cut rates this time round. That's why they should have been cutting rates slightly earlier to preempt what was going on. And of course, in the background, you've always got this political phenomenon, haven't we? The Federal Reserve, entirely independent. But as we know, there's an election looming in the United States of America, and therefore you have to be very, very careful that all the data lines up in favor of a rate move in order that you're not seen to be playing politics.
Wow, a traumatized Fed. I never pictured it like that. So if you were able to sit and talk with Fed Chair Jay Powell, we're seeing the CME Fed Watch tool is pricing in more than a 70% chance of a 50 basis point cut in September. Do you think that's an overreaction? Do you think that's an underreaction? What would you tell the Fed to do?
I've got to say right now, if you come in and do 50 basis points in September, that could actually unnerve the market to some degree. We've really got to see what that data is. I do think, to be fair to the Fed, even though they have made mistakes in the past by letting the inflation genie out of the pack, they need to think coherently about what they're doing. I think it's more likely we're probably going to see a series of small cuts. They'll probably take 25 basis points. Maybe they'll go the whole hog with 50 basis points, who knows? But certainly I think we've got to allow for the fact that they're going to have to cut rates during the course of September, simply to show the fact that they are caring. I think also there's a data issue here. A lot of the high-level data that's being absorbed by the world's central banks, the Federal Reserve in the US, the Bank of England in the UK, doesn't necessarily hit the bottom end of Main Street. And therefore, when suddenly we have this incredible epoch of data change, I mean, I was on the floor of the New York Stock Exchange essentially a month ago when we saw that unemployment number. It looked fantastic last month. This month, it looked appalling. Why? Not just because of the headline rate, because there was a huge ripple of different revisions that were going through the whole field. So the whole, if you like, yield curve of unemployment suddenly looked very, very different going back several months.
Okay, let's talk crypto, because all this volatility also impacting crypto. The price of Bitcoin was above 68,000 a token. I just looked at it. It's below 55,000. Wow, just over a week later. Ether sold off even more significantly. Do you think there are additional or different fears that crypto investors have at this point?
I think the issue here is actually one that there is a fallacious notion, Alison, which is the idea that crypto is somehow or other an asset class on its own. It's actually traded, and its history is an incredibly speculative asset class which loves the idea of cheap money, which therefore people are going to throw in. Because let's face it, when you buy Bitcoin, unlike buying the stocks on the New York Stock Exchange, you're not going to get a dividend. You're just looking at capital appreciation. And that's why throughout the course of history, a lot of the Bitcoin acolytes have tried to say, oh, it's the new era of money, whereas actually, realistically, what we've ended up with, and don't forget I've been a crypto advocate for over 25 years, is something that ultimately is just a speculative asset, and rather like gold, but without the industrial application, Bitcoin, all of these other cryptocurrencies, they're essentially just pixels that people are speculating on. And that's a very, very different thing entirely. And that's why, as soon as the stock market goes down, people are looking around, they're going, oh my goodness, I better pull some capital back so that I don't lose too much money. And they're selling out of things like Bitcoin very, very rapidly. So therefore, I would say overall, we're going to see a similar equivalent tracking of the cryptocurrencies against the health of the stock market and the risk on assets.
All right, Patrick Young, thanks so much for all of your great analysis.
You're welcome.